Hey guys, it's Mrs. Invest. Today's video is going to be about how I would invest my first $10,000 if I lost everything and had to start all over again. And one of the most common comments I get is from people being like, okay, all of this theory is great, but can you just tell me what to buy, what stocks to buy? I don't want to spend time learning, just tell me what to buy. And I think as YouTubers, we have to take a certain level of responsibility in talking about specific stocks or recommending stocks because, you never know online who looks up to you and takes your opinion very highly. And I would never want my recommendation to turn out poorly or cause anybody harm when it comes to investing in the stock market, and there's a couple reasons for this. Number one, there's no such thing as one perfect portfolio. If there was, we would all just have the same portfolio and investing would just be as easy as going for a walk around the neighborhood. And the second thing is, what is an amazing portfolio for one person might be a terrible portfolio for somebody else. And there's a couple key factors that really determine what's a good portfolio for you. Things like your age, your risk tolerance, what's your ability to handle market downturns or market losses, whether you're in the growth stage of your portfolio or whether you need income from your portfolio, and how far you are from retirement. And so my real goal with this channel is to provide investment education that's easy to understand and maybe even a little bit entertaining sometimes, and give you the tools and knowledge to make the best decisions for yourself. So back in the day, circa 2009, I made my very first stock purchase, which was shares of Bank of Nova Scotia. And honestly, thinking back on this time, I literally knew nothing. I had no knowledge of anything to do with the stock market. But thankfully, I had some family members with a lot of knowledge who kind of helped me learn the ropes and show me the way. And really, I give credit to them for helping me get to the point where I'm at now. And I feel like a certain need to want to give this back to other people in the best way that I know how, which is, I guess, making videos on the internet. I don't know. But if all of that knowledge was gone, if all the money was gone that I had tomorrow and I had to start all over again with $10,000, how would I invest it? Now, first, a couple assumptions. I'm going to assume that you have $10,000 to start out with. I'm going to assume that you have at least 5 years before you need the money. You need this money, preferably more than that, but at least 5 years. I'm going to assume that retirement for you is a ways away. I'm also going to assume that you're able to handle 40 to 50% drawdowns in your portfolio. That means you would be okay if today was 10,000 and tomorrow the market crashed and it went down to 4,000 or 5,000. You would psychologically be able to tolerate that without selling out. And I'm going to assume that you're a Canadian with a TFSA or an RRSP or both. And I'm going to assume that you're interested in doing your own DIY investing and you've realized that a savings account is never going to get you where you want to be and that you want to get your money working for you. Okay, holding number one, that I would make 50% of this portfolio or $5,000 of the $10,000 would be to invest in either an S&P 500 ETF or a US total market ETF. Now, the difference here is with the S&P 500, you're going to be investing in the 500 largest companies in the US only. If you invest in the US total market, you are going to be getting those 500 along with everything else. Honestly, I like these equally, and for me, it's just a toss-up investing between the two, and I personally own both of them. Now, when it comes to investing in the US market, whether it's the US total market or the S&P, you are mainly going to be getting growth with this investment or capital gains, meaning you buy shares and over the long term, those shares increase in price. You will get a small distribution as well. It's not a dividend, but it is a payout of cash, but it's a very small percent of the total return in comparison to the growth in capital gains. So you might say, Mrs. Invest, we're Canadian. Why are you investing half of your starting portfolio in the US stock market? And actually, it's funny, every time I talk in my videos about investing in the US market, there's always this one person who comments and tells me how I'm like a traitor to Canada and an embarrassment to the nation for investing outside of Canada. And I promise there are Canadian things coming, but I love investing in the US market. The reason is the US stock market has so much breadth and depth to it. It has some of the biggest companies in the world. And if you are going to bet for something doing well in the long term, you would be pretty hard pressed to bet against the US stock market. And I think there's very few absolutes when it comes to investing, but I think that investing in the US stock market is one of the absolutely good investments you can make, no matter if you are a beginner or an old man. Now, when it comes to investing in the S&P or the US total market, you can find ETFs with almost every fund, and you can also find them in Canadian and US dollars. So I'm partial to Vanguard and BlackRock iShares. That's who I buy the majority, well, all of my ETFs are either bought with through Vanguard or BlackRock iShares, but like pretty much every bank has their own version. Like BMO, everybody has made an S&P 500 ETF, and they're all pretty much the same. So just find a fund who you like. If you're looking at Vanguard and iShares, you have VFE and VUN, and you have XUS and XUU. And I'll put the management fees up on the screen as well. And when it comes to US dollars, you have VOO and VTI, and you have IVV and ITOT. And if I was holding the ones in US dollars, I would definitely be prioritizing holding those in my RRSP. The Canadian dollar ones, I mean, they're pretty good to hold anywhere. You could hold them in your TFSA, you could hold them in your RRSP, you could hold them in your non-registered, but if you're buying them in US dollars, I would definitely hold them in my RRSP. And if you want to watch my recent video about which stocks are best to hold in which different accounts, I will link that at the top here as well. And VFE is probably one of my favorite ETFs, and like just thinking about it, I start to smile because it's like a monster. It's so easy to invest in. You just throw money at it and the thing just produces cash and it just keeps growing. And I think that one of the things I've tried to nail down what is so sneaky about this ETF that catches people by surprise. And I think I've nailed it. I really had to think hard about this, but I think I've got it. You can tell me if you disagree. But it's almost like the growth in VFE, VUN as well, but the S&P 500, it almost like sneaks up on you because it's so easy to invest in. You literally don't need to know much, and it just is always growing for you in the background. And because it's unlike a stock in that stocks, they fluctuate more and more per day, both up and down. And so when you are looking at them day to day, you're like, wow, something's really happening here. But when you average it out over the long term, you know, all those super up days and super down days, they kind of get canceled out. Whereas with VFE, the majority of days are slow growth up. I don't know how else to describe it better than that, but it'll be like, if you look at the daily chart, it'll be like up 0.3% today, and you're like, 0.3%, what's that? But like the next day is 0.3%, and the next day is 0.3%, and the next day is 0.5%. And so it's all those days, day after day after day, that this ETF is compounding for you, and it's just like a monster that is growing in the background. Like I bought some shares of VFE like not too long ago, and it was trading at $80, and now it's trading at $99. And there's like not one day that I looked at it on my watch list where it was like up a very large percentage in one day. So it's like kind of sneaky. It just like, it's almost like it sneaks up on you, the growth, and you don't really notice it day to day. But when you look back over the long term, you're like, how did I end up with so much money? So it's just one of my favorite ETFs. I love it, and it's so good. It's so good. The growth just sneaks up on you. I don't know how else to describe it other than that, but it's truly one of my favorite investments because it's so damn boring, but it's so damn good. And the second holding that I would make 30% of this portfolio, or $3,000 of the $10,000, would be a Canadian dividend paying stock. Now, if the Canadian stock market is known for something, it's known for having a fairly hefty list of really reliable dividend payers between the utility companies, the oil companies, the Canadian banks, and the telecoms. Now, I'm partial to the Canadian banks because I find them to be pretty safe investments as far as the stock market goes, and they pay out ever increasing and very reliable dividends. Now, with $3,000, I would probably just invest all $3,000 into one of the banks. My favorites at the moment are Royal Bank and TD Bank. National Bank is pretty good too. So for $3,000, you could buy 23 shares about of Royal, which would give you $99 a year in dividends, or you could buy about $35 or 35 shares of TD Bank, which would give you about $110 a year in dividends. Now, you might ask, why don't I invest in a broad market index of the Canadian stock market, of the TSX? And the reason is I find that the Canadian market as a whole lacks a lot of breadth and depth, and especially growth. So in comparison to the S&P or the US total market, an index of the Canadian market I find trades far more horizontally and grows in capital gain far slower at a more flat slope than the US market, which means less money over time. So for my Canadian exposure, I just prefer to hold Canadian individual dividend paying stocks directly as my exposure to Canada. But you know, if you wanted to hold an index of the TSX, that's totally fine. It's just not my favorite thing to do. But some good ones are XIC or XIU with BlackRock Ishares, or VCN with Vanguard. And for the remaining 20% or $2,000 of the $10,000, my third holding would be an international index ETF to get some international exposure outside of just North America. Now, to go and buy individual stocks internationally in all these different currencies in different countries is just too much of a headache for me. It's too annoying and not worth it. So I would definitely go for an ETF here. You know, we don't have to overcomplicate things. We can keep things simple and do just as well. VXC is a good one. It's a global all-cap ex-Canada index ETF. So you're going to be getting emerging markets, small, mid, and large cap companies of internationally, excluding Canadian. So you're definitely going to get a bit of US in there as well, but you're also going to get international. XAW is another good one, which I talked about in my video called 3 ETFs for Life. But any combination of small, mid, large cap companies internationally outside of US and Canada, I would dedicate to this remaining 20% of my starting portfolio. So to recap, this $10,000 starter portfolio is made up of 2 ETFs and 1 stock, and 3 holdings I think is plenty for just starting with $10,000. I don't think you need to overcomplicate this with way too many holdings. And as a beginner with little knowledge, it's easy to do, it's easy to invest in. You get exposure to the great growth of the US economy, you get the dividend payout from your Canadian dividend payer, and you get a little nibbling of an international index. And as you are accumulating more money, I would probably just add to these holdings rather than buying different things as I got more money. And as the years go on and you gain more knowledge, that's when you can figure out what kind of investor you are, whether you want to increase your position in ETFs or if you wanted to go into individual stocks. But you have lots of time to figure that out. And in the meantime, this portfolio is compounding for you in the background at 10 to 12% per year. So that's all for the video. Like it, subscribe to my channel if you would like, and I will see you guys. Oh, and follow me on Twitter at MrsInvest1, where I post a lot of my thoughts and updates on the stocks that I'm holding during the week. And I will see you guys in the next one. Bye.